Boosting industrial production to meet the demands of today's threat environment has become one of the Department of Defense's most pressing challenges. One solution the Pentagon has already begun putting into practice is doing large, longer-term deals with specific companies that include significant private capital investments. In some cases, it has meant that the U.S. government is taking equity stakes in key suppliers, something that has rarely been done before. In this episode, we'll start with an overview of this recent wave of DoD deals, and then we'll turn to Byron Callan, a defense analyst with Capital Alpha Partners, to explore the significance and implication of these latest trends. As usual, I'm your host, Jerry McGinn, and welcome back to another episode of All About the Base. The Pentagon is getting creative on how it's attempting to boost industrial production and build capacity. The administration is engaging with private equity, venture capital, and company-backed investments to fund major industrial expansions through the use of larger, long-term deals that help drive demand certainty and build scale. Private capital investments from many sources such as PE, VC, and large publicly traded firms, and as well as different tools such as loans, offtake agreements, and public-private partnerships. And finally, government equity stakes, a tool rarely seen in the U.S. defense marketplace. DoD has already begun to make big changes to its acquisition processes to prioritize speed and scale. This has included efforts to provide industry with consistent demand signals through large, longer-term, and more predictable contracts to companies that are investing in new capabilities and expanding infrastructure. But DoD is taking this a step further through equity investments that position the government as a direct investor in critical suppliers. Let's look at three recent examples to demonstrate these trends. In 2025, in July, the U.S. government made a large deal with MP Materials, the largest U.S. producer of rare earth minerals and processed materials. This will enable MP Materials to scale its annual production of magnets from 1,000 metric tons in 2025 to 10,000 metric tons over the next decade. The major components of this deal include, number one, a $1 billion loan from JP Morgan and Goldman Sachs, a $150 million government-backed loan from the Office of Strategic Capital, a 10-year DoD offtake agreement that commits the purchase of a certain amount of rare earth processed materials at a guaranteed price floor, and finally, a DoD equity stake of $400 million in preferred stock that positions DoD to become MP Materials' largest stockholder. From 2020 to 2024, DoD awarded roughly $450 million to establish rare earth element supply chains in the United States to reduce reliance on foreign sources, primarily from China. While these investments were a step in the right direction, their impact was limited. These larger scale deals, such as this MP Materials deal that the current administration is rolling out, attempt to create bigger market impacts. Another example is DoD's $1 billion investment in L3Harris's Mission Solutions business. This will soon become a publicly traded company, a separate company. The Pentagon will have an equity stake in the business, though L3Harris will remain the majority shareholder. The intent of this agreement is to boost solid rocket motor production, which has struggled to keep up with munitions demand with only two major domestic suppliers, L3Harris and Northrop Grumman, although there are several new entrants that are also attempting to enter this marketplace. This marks DoD's first direct-to-supplier partnership, which, according to the department, calls for Department of War to negotiate and invest directly with critical suppliers to save money and time while proactively managing single points of failure. Additionally, DoD and Lockheed Martin recently reached a deal to more than triple Patriot missile production over 7 years. Currently, Lockheed produces around 600 Patriot missiles annually. The new framework aims to increase output to 2,000 per year by 2030. This framework agreement is a direct outcome of the department's acquisition transformation strategy and provides industries with a long-term demand signal. DoD is currently working directly with key Patriot subcontractors to expand capacity throughout its supply chain. This agreement differs from the MP Materials deal as well as L3Harris in that Lockheed is using its own corporate capital to scale production, and DoD does not provide a loan or take an equity stake. These three examples are not alone, and the overall trend illustrates how the department is using longer-term investments to grow production capacity. There is also a signal to private capital markets that U.S. is committed to backing industrial-based resilience through direct financial participation. The government is making these long-term agreements, or carrots, but it is also sending a clear signal to industry that it must produce and invest. The recent executive order prioritizing the warfighter in defense contracting reinforces this expectation that government contractors must prioritize production capacity, on-time delivery, and readiness. Its tone is much more combative and looks to be more of a stick as opposed to the carrot of longer-term deals. Now let's turn to Byron Callan of Capital Alpha Partners to help us unpack all of this. I'm thrilled to welcome Mr. Byron Callan, our good friend and one of the, if not the premier analyst on aerospace and defense trends. And it's been a very busy time for you, Byron.
It's a pleasure and honor to be here, Jerry. I'm glad to join you today.
Great. Well, I want to start off with, what is driving kind of the larger and long-term agreements? We've seen a lot of big agreements. And what are the benefits and risks of these efforts?
Well, I think the first trend is just what's come out of the war with Ukraine, and really also the realization about how much munitions capacity we're really going to need in a high-end conventional conflict. And this had caught the attention of prior administrations, but this administration is really moving out with some new initiatives, as you pointed out in your opening comments.
Okay, great. And a big part of this has been a lot more engagement with private capital.
Right.
Ventures, capital, private equity, big companies. What are the implications of this trend? And why are they doing the engaging more with private capital?
Well, I think part of it, obviously, there's an availability of funds. People are willing to invest in the sector. They see it's not just the U.S. defense budget that's been increasing. We've got global defense spending growth occurring as well, too. I think it's just being seen as we have a whole range of defense entrants, companies like Anduril, Shield AI that are private but have been able to really capture the attention of the VC community. And typically when you see these waves of entrants, they tend to ride new technology. So in the space sector, in autonomy, in AI, that's where a lot of these new entrants are kind of parking their expertise. And that's a trend we've seen in the past in not just the U.S. defense sector, but global sectors too.
Gotcha. What is happening in global capital markets that's causing investors to focus more on defense?
Well, again, it kind of goes back to the growth, the demand signals that are being put out. This data just shows that capital markets have been open for defense. In other words, institutional investors and retail investors have been willing to buy. These are initial public offerings or secondary offerings that have been completed by companies in 2025. The list is primarily U.S. companies. But if you go down to 2026, there have already been at least one deal with a fairly large European defense contractor that also helps the U.S. defense industrial base, the Czechoslovak group. So I expect this will continue in 2026 so long as these hopes and expectations are alive for global defense growth and some of these policies that provide a demand signal. You'll probably see more defense privatizations in Europe. Some of these defense venture-backed companies will probably go public as well, too. And to your point on L3, that's going to be a new standalone business, the Missile Solutions business, will come public as part of this deal with the department.
Okay, great. Now, we've seen, in addition to these deals and the influx of private capital, we've seen the U.S. government start taking equity positions in these deals. It was something we've really never seen before. Can you talk a bit about that and, why do you think that's happening and where do you think that's going?
Some of it, I think, is you have people at the most senior levels in the department who've come from private equity background. So I think instead of just having the government loan money and get a return on basically the return of capital that has been loaned to companies, which historically is the way this was done, not just in the defense sector, but think of the automotive sector and the bailouts that occurred after 2008, 2009. So it really provides some upside or a return on investment for the department. The L3 deal that you mentioned, that's a convertible preferred stock that I think it'll convert at 20% below the IPO price. So there's potentially some upside built into that. Government won't just get its money back, but will earn a bit on top of that. Again, assuming everything goes well, and that's always an open question in this sector and other sectors too. That leads to the question of this, because we really haven't done this before in the U.S. I mean, European companies, some governments have golden shares or so, but this is a little different. Are there risks to doing this in terms of what if companies don't succeed, right? And then also, does this make the government sort of a competitor? So how does this kind of play out? Yeah, the thing that I'd watched, Jerry, it came up in some of the earnings calls. A lot of these companies just reported their results for the quarter that ended in December, and they gave forward-looking guidance. And sell-side analysts typically ask questions during the call. So it did come up on some of these calls about what does the L3 deal mean for you? I didn't hear a lot of clear answers. But it's a little different when you have a government stake where you're actually looking for a return on that investment, not just a return of the capital was employed. So is there a risk that there might be some kind of favoritism? If the government now has a stake in the missile solutions business at L3, what does that mean for some of the smaller entrants that you referenced? And for Northrop Grumman, if there's not a similar deal that's cut? That's going to be something to watch, and I think is going to be very important to see how it plays out.
Okay. And now, those are a lot of the carrots in terms of these significant deals, right? And some of what they're taking is sometimes government equity positions. But then there's some clear sticks that have been, the executive order on buybacks and some of the tone of some of the leadership. So how is restricting dividends and stock buybacks, how does that affect customer incentives, investors, and access to capital in the defense sector?
I think the key point, look, companies, I wrote a paper called, the other partner for the Department of Defense are basically shareholders, institutional investors. And they own these stocks because they expect some kind of appreciation. In some cases, they own it because of the dividend. And what I heard in these last round of earnings calls, some of the larger contractors, General Dynamics, for example, they're not going to cut their dividend. The share buybacks, I think what you probably see is a pause in share buyback activity. It's run a couple of $1 billion a year, quite frankly. Companies will probably pay down their debt, and then we'll see where we go with this. But they're still going to generate free cash flow, and there's not a lot that they can do with it if they don't have that clear demand signal, because their investors are going to look for it. They don't want to see them build plants willy-nilly that can't get filled with business. So that's going to be an important thing to watch as we move through this year and into next.
Yeah, I wrote a piece about a year and a half ago and looked into this, and companies, investors and their shareholders demand that they, use their free cash to the best benefit. And if there are other incentives where demand, contracts or expected contracts, the companies will spend it on. Otherwise, they have to, buy back stocks. So it'd be interesting to see how this develops.
Well, and it's also, Jerry, it's not a new issue.
Right.
No, you can go. This has been a perennial problem for the department, particularly when you're appropriating money on an annual basis. Multi-years give you some visibility, but I've referenced it's a U.S. Army, part of the U.S. Army official history in World War II. This was a big debate in 1940 when the U.S. was trying to get companies to invest ahead of the surge in demand in aircraft production. And there was a lot of debate that was similar to the debates you see today. What happens if the demand doesn't materialize? How do you incentivize companies to make these kind of bets when the future is inherently uncertain?
Wow. Yeah, well, there's certainly going to be lots of discussion on these and other issues related to production and private capital involvement and the government equity stakes going forward. So I want to thank Byron for joining us for this episode, and we look forward to seeing you soon. And remember, it's all about the base.